Good morning, everyone. My name is Christian Musbach. I'm a senior in the AIM program covering domestic real estate. My mentee, Elisabeth, is a junior in the AIM program also covering domestic real estate. Today, we'll be pitching Americold Realty Trust, ticker COLD. Before diving into our recommendation, we'll first begin with our screening process. We want to find a REIT that had exposure to the growth in e-commerce, which led us to the industrial space. Cold is the only temperature-controlled warehouse REIT in the industry and has not been negatively impacted by the pandemic. Due to the growing niche market it is in, we chose Americold Realty Trust. Now we'll give an overview of Cold. Americold Realty Trust is a real estate investment trust which develops, acquires, and manages temperature-controlled warehouses. The portfolio currently consists of 183 warehouses with 1.1 billion cubic feet of space. These warehouses expand across the US, Australia, New Zealand, Argentina, Canada, and Brazil, with around 2,600 customers worldwide. Located on the next slide is a map containing the current property locations globally. The company generates revenue from warehouse income, which is around 77% of their revenue, third-party managed, 14%, and transportation, 8%. Cold's end markets include food manufacturers, which is around 76% of their income, and retailers, 22%. The overall strategy is to acquire and develop temperature-controlled warehouses in strategically located areas across the globe. We will now look at a few recent acquisitions and developments. A recent development is two automated retail fulfillment centers in the Northeast and Mid-Atlantic US, which will serve around 750 of AD USA stores. AD USA is the second largest grocer in the world, and the contract is a 20-year commitment with a 10 to 12% expected stabilized NOI ROIC. This deal commenced in the second quarter of 2020 and will fully stabilize in the second half of 2023. Now, on the acquisition side, besides the recent announcement of the Agro Merchants Group acquisition, Cold acquired two companies in August of 2020. These deals expand their presence in the Dallas, Fort Worth, and Florida markets. The map below shows the exact locations and the current locations for Cold. Now, onto the recommendation. Americold Realty Trust is one of the leaders in the temperature-controlled warehouse industry. This niche area allows Cold to generate above-average returns for the industrial real estate space. The warehouse revenue segment consists of its temperature-controlled real estate, which generates rent and storage income. Cold focuses on acquiring properties in strategic locations and pairs it with their best-in-class IT interface, which sets it apart from its competitors. The third-party managed segment consists of the revenue generated from managing customer-owned warehouses. The smallest segment, transportation, consists of brokering and managing the transportation of its customers' products. This includes consolidation services, freight under management services, and dedicated transportation services. This segment enhances customer retention and drives warehouse storage and occupancy. It also aids in the supply chain efficiency. Given the 18% US market share and 4.4% global share, this scale allows Cold to generate top-line growth through acquisitions given its strong capital structure. Currently, Cold does not have any significant debt maturities until 2023, and around 90% of its debt is fixed. It also has $1.2 billion in liquidity, which includes $800 million of undrawn senior unsecured revolving credit facility. This has allowed Americold to be active in the development and acquisition space. Due to Cold's strong business model, geographic diversity, and solid capital structure, it is recommended that Americold Realty Trust be added to the AIM Equity Fund with a price target of $43.89, representing a potential upside of 18.98% with a 2.28% dividend yield. We will now go into our drivers. The first driver is Cold's Agro acquisition. Americold recently announced the acquisition of Agro Merchants Group for $1.74 billion. Agro is the fourth largest temperature-controlled warehouse company in the world and the third largest in Europe. The deal is expected to be finalized in the fourth quarter of 2020 or the first quarter of 2021. Agro currently serves over 2,900 customers with its 46 facilities. These facilities equate to around 236 million refrigerated cubic feet across 10 countries. This acquisition will allow Cold to expand its operations in Europe while also complementing its portfolio in the US, South America, and Australia. Cold's in-depth expertise in these key locations will promote a seamless acquisition process. This will also give the company the ability to diversify its customer base while being able to serve its multinational customers on a global scale. The deal is expected to generate a net entry NOI yield of 6.3% and an adjusted EBITDA multiple of 22.3. It is expected that NOI yield will stabilize at a range of 7.3 to 8.3% by the sixth year. The second driver for Cold is the organic industry growth in the food industry. The food industry has trended towards a cleaner lifestyle in recent years. This includes quality and fresher produce and meat products. COVID-19 has shown people the savings and benefits of staying at home and cooking themselves. This has increased the demand in grocery stores and direct-to-home shipments. According to BMC, the number of people in the US who shop for groceries online grew from 13.1 million in August of 2019 to 43 million in May of 2020. The properties, distribution chain, and technology will give Cold a competitive advantage to capture this industry growth. The I3PL supply chain control from Americold gives customers direct access to real-time information and analytics about their inventory. The investment made into this technology should allow Cold to expand its revenues from service fees. The last driver for Cold is its diverse business model. Americold currently serves 6 countries with around 2,600 customers. The top 25 customers account for approximately 58% of the warehouse revenues, and none of its customers account for more than 8% of total revenues. The diversity in its business model will allow them to serve multiple end markets without relying too heavily on one customer. Cold has also gradually transitioned from an as-utilized business model to fixed storage, commitment contract, and leases. 12 of their top 25 customers as of the beginning of July have signed fixed leases. This will decrease the risk of unsteady cash flows as they continue to promote this business model. Now we'll touch on our valuation. In order to reach an intrinsic value for Cold, a dividend discount model was constructed. Using a cost of equity of 5.21%, intrinsic value of $45 was reached. Additionally, a 5-year DCF was constructed. Using a terminal growth rate of 1.5% and a WACC of 4.79%, intrinsic value of $44.16 was reached. A sensitivity analysis of plus or minus 50 basis points on the terminal growth rate and plus or minus 50 basis points on the WACC ranged from $38.34 to $52.14. Finally, a price to AFFO multiple was calculated. Using a 2020 estimated AFFO per share of $1.04 and utilizing a blended average price to AFFO multiple of 39.51 times, resulting in intrinsic value of $41.12. By weighting the models 40, 40, 20 respectively, a price target of $43.89 was reached, resulting in a potential upside of 18.98%. Cold pays a dividend yielding 2.28%. Now we'll touch on risk. The first risk we see to Cold's long-term success is their short-term contracts. Around 60% of the contracts that Cold has with its customers are not fixed commitments or leases. Most of these short-term leases are also not required to utilize a minimum number of pallets within the facilities. Despite the company's current push towards more fixed contracts with its customers, its current structure limits revenue visibility. The second risk we see are their low occupancy rates. The occupancy rate for Cold is currently around 79.7%, which is slightly above its 3-year average of 77%. However, the company reports that the optimal occupancy rate is around 85% to generate maximum four-wall cash flow to net operating income. If the company is not able to increase its occupancy rates, this could inhibit optimal growth. Lastly are the increased construction costs. The rising cost of construction and labor could inhibit Cold's bottom line. Development is a major part of its strategy.
Fred Bowler was promoted to chairman and CEO in 2015 and served as the COO since joining the company in 2013. Prior to joining the firm, he managed a leading grocery retailer and wholesaler for 10 years. Working alongside him is Mark Smirnoff, the CFO and Executive VP, who joined in 2015 with more than 20 years of investment banking and accounting experience.